Benjamin Franklin once said, "An investment in knowledge pays the best interest." And when it comes to investing, nothing will pay off more than educating yourself. So do the necessary research and analysis before making any investment decisions. In today's video, I'm analyzing Ajanta Pharma. The company was incorporated in 1973. It is involved in development, manufacturing and marketing of pharmaceutical formulations for both domestic and international markets. It has a well-diversified product portfolio across therapeutic segments such as antimalarial, cardiovascular diseases, dermatology and ophthalmology. Ajanta Pharma is also increasing its presence in other specialty therapeutic segments such as pain management, gastro, anti-gout as well as antibiotics. It has manufacturing operations which are spanning around 8 manufacturing plants, 7 in India and 1 in Mauritius. The 6 manufacturing facilities for formulation and 1 manufacturing facility for API are for captive consumption, which are located near Aurangabad, Maharashtra. Next, let us look at the core ratios of Ajanta Pharma. The market cap is 13,405 crores. 3 years back, the market cap was around 15,494 crores. So from there, the current market cap has fallen considerably. And from 5 years back, although it has gone up, but not that considerably. Current price is 1,536 rupees and it is nearing its 52-week highest point of 1,760 rupees, whereas its lowest was 942 rupees. And when you understand the technical analysis, you will understand where exactly you can put your buys and where you need to get out or sell the stock. The current price to earnings ratio is at around 24.1 times, which is near my benchmark of 25. Book value is 334, so it is trading at a high premium to its net worth, almost 5x. So price to book is almost 5x against the net worth of the company or per share. The book value 3 years back was around 232 rupees. So the company has managed to increase its net worth over the years. Company is paying very less dividend of less than 1%. Return on capital employed and return on equity are quite good and way above my benchmark of 15%. So the company is quite efficient in generating profits on both shareholders' money as well as on total capital employed into the business. Face value is 2. Number of equity shares outstanding in the market is 8.7 crores. Company is generating around 30.4% OPM margin since last 5 years on average, which is a very good value. It has given a return of 54.1% on shareholders' price or investment over last 1 year. But over a period of last 3 years, the returns is very minuscule of just 3.39% growth, whereas over 5 years it's just 2.96%. So what this signifies is that the current price is very much near or not very far off from where it was 5 and 3 years back. So it creates a good opportunity to buy into the company. But for this, we'll need to understand the technical chart, which I'm not going to discuss in this particular video. The current debt is only 24 crores, which is a very small value compared to its market cap of 13,405 crores. So the company is almost debt free then. This is what it means. In the preceding year, it was 36 crores and 3 years back, it was hardly 1.28 CR. So the company is debt free. Interest burden as of the recent 12 months is just 8.35 crores. Company is collecting payment from its customers in 109 days, which is way above my benchmark of 90. 3 years back, it was collecting in 60 days. So there's definitely some kind of pressure on the company to give more credit days to its customers to pay back. So this is not a good sign. As the debtor days increases, the pressure on the working capital also increases. But if the company is in a good position, then they can give a little leeway and extend the credit period to its customers. But it has gone up quite substantially from where it was 3 years back. Company's investments is 272 crores against the total balance sheet size of 3,671 crores. This is a reasonable investment, very small investment. Cash is also very small at just 214 crores. Trade receivables are 755 crores. So against the total balance sheet size, this is approximately less than 20%. So here also this is good enough. It's not that substantial to collect, but we'll need to compare this trade receivables against these sales, which we will do when we do the peer group analysis. But as of in front of balance sheet, this ratio is good. Trade payables is also very nominal. What in all of this analysis, what we are trying to do is find out red flags, faults in the company's numbers, and thus avoid investing in these companies. Or if we have to invest, what are the good points in them? So we are doing both the things, finding out faults as well as finding out good points about the company, which through which understanding which we can invest in it. Working capital is positive, that is, they have enough assets to pay the current liabilities which may arise in this recent 1 year. Company's assets are around 1,429 crores and is increased quite substantially from where it was 3 years back, which signifies that company's capital investments have increased quite substantially over the 3 years, almost 3x over the last 3 years, which means the company is expanding its assets. Compared to the balance sheet size, this is quite huge, almost 40 to 50%, I suppose. Not 50%, at least 40% or so. So that is a very big portion of the total balance sheet size. If the company, since the company is debt free, investments in fixed assets, although it should be done at a reasonable pace, but this seems like quite a huge percentage of the total balance sheet size. Company has no debt on its books and a very insignificant portion of the profit which can be very easily cleared off. Current price is around 4.9 times its revenue generated. So again, quite a premium we are paying. Around 2.53 times the sales is good enough for us to pay. But then we have to look at long-term trend as to where market cap to sales was. If you are interested in learning from me, you can contact me on my email address, and you can drop in a mail and I'll revert back to you. Moving on, we'll check out the profits of last 5 years is 2,253 crores. So comparing it to the current balance sheet size of 3,671 crores, company has generated huge profits over the last 5 years. In fact, most of it is still left with, most of it has got converted into cash from operating activity over the last 5 years at around 2,000 crores. And a substantial portion of that is still left free at 2,063 crores. So company is in a very good cash position as of today. Return on equity over the 5 years has seen a degrowth of almost 15%. So the ROE value that we saw earlier has been decreasing over the period of last 5 years by around 15%. So that's a degrowth. So generally we want the ROE also to be increasing as the company is growing its overall balance sheet size. Let's move on and look at Ajanta Pharma and compare it with Wockhardt and Strides Pharma. The current market price of Ajanta Pharma is 1,536 rupees per share. Wockhardt is at 452 and Strides at 764. All three companies have almost reached or very near to their 52 weeks high. Wockhardt and Strides Pharma are very much near to their 52 weeks high, and Ajanta Pharma is down by around 12%. Results are up to date till March annually, and quarterly it's up to date till September 2020. Ajanta Pharma's sales have gone up by 11% and profits have gone up by 45% from its previous year's quarter of September 2019. Whereas Wockhardt's sales have gone up by 4% and the profits have gone up by almost 103%. But here in the previous quarter, Wockhardt had suffered a loss and now it has turned back into positive gain. Whereas Strides Pharma has also seen a drop in its profit by almost 3.9% from 142 crores to 80 crores. Now these values are excluding or including exceptional items when compared whether it is a gain or loss. So this number of 3.97% is not the correct one if you look at the actual values, but as a percentage when adjusted for exceptional items, it is only 3.97% drop in the profits. If you look at the March 2020 total annual sales of 2,587 for Ajanta Pharma, almost all of these three companies are very much nearby or equivalent in terms of generating revenues. In fact, even in the recent 12 months, almost the same values, and the profit for Ajanta Pharma was from 470 crores for the entire March 2020, which is almost 20%, to around 556 crores in the recent 12 months. In fact, the profit has gone up quite substantially from March 20, whereas Wockhardt's losses have increased from 43 crores in March 20 to 477 crores. So this needs to be investigated. What is the issue here? Strides has managed to increase its profits from 56 crores in March 20 to 166 crores in the recent 12 months. So both Ajanta and Strides have managed to do well compared to Wockhardt in terms of at least profits. Although in March 20 it had suffered a loss of 43 crores, it managed to generate a cash of around 648 crores. So as I mentioned again previously, that you need to investigate into Wockhardt's cash flows and profit after tax values to understand what is the issue in the company, why is it generating so much cash and at the same time shown a loss of around 43 crores. Ajanta's profits of 20 and cash of March 20 are almost very nearby to each other, so this is a good value. In fact, Strides profits are very low, but the cash coming in is very high at 204 crores. So whenever you see a huge variation between the profits and the cash, the individual component items needs to be investigated, which you can do by looking at the cash flow statement. Price earning for Ajanta is at 26, Strides is available at 13. For the last 5 years, the Ajanta Pharma's price earning is at 26 and current is at 24. So the current price earning is very much near its average of around 26 or 25, whereas Strides current price earning is very high at 41 times compared to its averages of 13. So this also needs to be investigated. Anytime you see a huge variation, you'll need to go quickly into the individual line items and check out what is the earnings, what is the profit, is the ratio correct. This is a core ratio. Once you understand these ratios, you can decide whether you want to investigate further and devote more time into studying the company's fundamentals. Wockhardt, since had suffered losses, we don't have the price earning, whereas on an average it was quoting at around 42 times, very expensive. Price to OCF wise, Wockhardt is at 7.7, Ajanta very expensive at 29, and Strides even more expensive at around 33 times its operating cash flows of 2020. So these are both Ajanta and Stride needs to be somewhere around 25 or below that for an entry. Price to book wise, the cheapest is Wockhardt at 1.45, Ajanta is most expensive at 4.6 times its net worth, and Stride at 2.5 times. So valuation wise, Wockhardt is cheap, but then there is losses in this company. So why would you want to buy into this? You need to investigate what is happening inside the company, because we have seen a huge variation between the profits shown and the cash earned. Profits have been growing for Ajanta at the rate of 8.3% over the last 5 years, whereas Stride has seen a drop of almost 41% since last 5 years in its profits, whereas sales have been dropping at around 50% compounded every year since last 3 years. In fact, the revenue the profits have seen a higher degrowth in the recent 3 years, whereas Ajanta also has seen a drop in its profits by around 2.63%. Wockhardt has in fact seen a gain in its profits from 3 years back. So anytime you see these individual items, these kind of variations, you need to look at individual line items. Sale wise, revenues for Wockhardt has been dropping by around 8.6% compounded from 5 years back. So even 3 years back, whatever sales it had done, from there also it has generated 10% less compounded over the 3 years. So which is not a good sign. At least even if there is a degrowth in profit, that's okay, but there shouldn't be degrowth in the revenue or sales, as that is the starting point and very important, because everything flows from the sales or revenue of the company. So if there is a pressure here, then it automatically indicates that the company is not managing to increase its sales, or there's a pressure on the company, and therefore that automatically would come down or trickle down into profits as well. Strides sales over the last 5 years is growing at 18%, but in the recent 3 years has seen a degrowth of almost very minimal, but it's almost near to where it was 3 years back. ROE only for Ajanta Pharma is very high at 19%. Over last 5 years also we see 25 and 20% returns. So this shows efficiency in terms of generating profits on the shareholders' money. Whereas Wockhardt over the last 5 years have been making losses, and in the recent 3 years also around 7.52% on an average. This is the losses it is incurring on shareholders' money. Strides last 3 years average ROE as well as 5 years is around 13%, but the current ROE is very low at 2.1%. So both of these companies, Wockhardt and Strides, are facing some kind of margin pressure, at least in the recent few years. In terms of return on capital employed, Ajanta has generated the highest at 27%. Even average, if you look last 5 years, 33 and 28%. Whereas both Wockhardt and Strides generated very less ROC on the total capital employed. So we would want to buy into Ajanta Pharma instead of Strides or Wockhardt. Even if you have to buy a little expensive, that's okay, but better to go for a good company. Return on assets is negative again for the last 5 years for Wockhardt. It has been suffering losses, whereas Stride is generating around 5.4, and maximum assets to profits is by Ajanta Pharma, generating around 27% on its total assets or balance sheet size. In terms of sales to assets, as to how much sales is or revenue is being generated on the total assets employed by the business, the highest is Ajanta Pharma, generating almost equivalent revenue to what it has in its assets. So assets and revenues are almost equal, whereas Strides and Wockhardt have not managed to generate that much returns or revenue on their assets deployed into the business. This again shows efficiency or inefficiency depending on what is the number. In terms of inventory turnover, all three companies' inventory level to against its sales is quite decent. All of these companies have generated revenue of, for example, Ajanta Pharma has generated 1.4 times higher revenues than the inventory holding. So what this again signifies is that most of these companies have a high inventory holding against their revenue. Generally, we would want to see at least 5-6 times higher revenue than the inventory holding. That's a good value. These values are very low, or rather we can say that the company is holding a high inventory level against the revenue that it is generating in the latest year. Let us look at the long-term 5-year picture. 5 years it has made total losses of 673 crores, Wockhardt, whereas cash generated is 589 crores, and it doesn't have any cash left with it because everything has been reinvested back into the business in buying assets. So negative 407 crores, and that is why it will need to take up more debt to fund this particular, or maybe use reserves to fund this additional free cash flows that has gone out of the business. Ajanta's profits of the last 5 years 2,252 crores, and the cash is also very nearby. The free cash flow is also very nearby to each other. So all of these numbers for Ajanta is very good. Strides profits of last 5 years is 1,600, and cash earned is half of it, almost 813. So the cash is not coming in, and it doesn't have any free cash flow left. In fact, it has gone negative 1,000 crores. So this also, I don't like this position as well as this way, where profits are negative, cash is positive. I want both the profits and the cash positive, as well as a free cash flows of almost 50% of the cash flow from operations. So if you don't understand any of these ratios, you can look at my older videos where I have gone in depth and explained each ratio. These are very long videos of more than 1.5 hours. You can watch them if you want to understand these ratios very clearly. Alternatively, you can also contact me. As I mentioned, I'm also giving online classes. So if you contact me, and we can discuss about the fees and everything. Market cap for Ajanta is 13,000 crores, Wockhardt 5,000, and Strides at 6,800 crores. Net worth wise, Wockhardt is at 3,454, 2,913 for Ajanta Pharma, and 2,688 for Strides. So all of these companies are still trading at a premium to their book value or to their actual value of each share. Contingent liability for Wockhardt, in fact Strides, is extremely high, so this again needs to be investigated. For Strides Pharma, 2,378 crores of contingent liability is a complete no-no for me. So whether this is a true value or it's just a one-off that needs to be investigated separately by going into the annual report. For Wockhardt it is okay, it is slightly around 15% or so, so that's all right. Should not exceed more than 20% of the net worth. Ajanta's contingent liability is the lowest at 50 crores. So the best in terms of contingent liability to net worth ratio. Both Wockhardt's debt as well as Stride Pharma's debt is high. Stride Pharma's debt is like 0.83% of 0.83 times its equity, and even Wockhardt's debt is there high at 0.63, whereas Ajanta is almost debt free. Since Wockhardt has been suffering losses since last 5 years as well as in the recent year, its coverage is negative, that is it is not able to pay its interest cost from the EBIT it is generating, whereas Ajanta's interest coverage is very high because no debt, and Strides Pharma's interest coverage has fallen below 4 times, which is my benchmark. So I don't like when companies interest coverage falls below 4 times. Minimum I want is 4 times. Promoter holding for both Wockhardt and Ajanta is above 70%, which is a good value, whereas Strides is at 29% low. Plus Stride Pharma has also pledged 37%. I don't like promoters pledging more than 20% of their shareholding. In both the cases of Wockhardt as well as Stride Pharma, we see a high pledge of about 20%. Ajanta's promoters have also pledged, but a very low 16%. Against its 70% holding, this is quite low, 16% pledge. Even Wockhardt's pledge is quite low at 22%, but it has exceeded my benchmark, so I would get alert. And although it's a huge promoter holding, compared to that the pledge is quite nominal. But again, as I mentioned, I don't like if it goes above 20%. Debtors to sales is 33%, again above my benchmark of 30. Ajanta has managed to keep it below 30, that is 30%, and Strides again has gone up above my benchmark. So both of these companies, Wockhardt and Stride Pharma, would be a no for me right now. Ajanta, yes, Ajanta can be considered definitely. Wockhardt is taking 159 days to collect payment from its customers. All of these three companies have seen a pressure on the collection days, that is how fast they are collecting payment from their customers. 109 days for Ajanta Pharma, it has also exceeded my benchmark of 90, and Stride Pharma also 123 days. Almost 4 months to collect payment from the customer is a huge time. We also have to look at how much suppliers are giving these companies to pay back. So that needs to be rechecked again, both of them. But as of the numbers in terms of debtors to sales and debtor days, so as of the numbers of debtors to sales ratio and the debtor days, Ajanta Pharma has scored the best. Ajanta's NPM margin of 2020 is 18%, whereas Stride Pharma is very low at 2%, and Wockhardt has suffered a loss of almost 1.53%. We don't have the dividend values as of now. So this concludes my detailed analysis of Ajanta Pharma with Strides Pharma and Wockhardt. Now this is a core ratio. After this you also need to look at the annual report. You need to read annual report, read the management's commentary, then look at the cash flow statement individually and understand what that cash flow statement is saying, and all of these things you have to understand in totality. This is just one part. 50% part is investing part, then you have to wait patiently, and the psychology part is almost 50% of your investment strategy. So understanding all of these is very important. Finally, if you enjoyed watching this video, do share and with your friends and subscribe if you haven't. Thank you so much for watching this video.